The juicy, the sexy. It's the get rich.
If you don't want to see other people get rich and you being left behind, this one is for you. If you don't want to see other people get rich and you being left behind, this one is for you. Whether you're seeking investments, maybe you want to work in venture capital or just want to become a brilliant investor, this masterclass is definitely something that you can have use for. And today, this episode is powered by LE Fitness. Do not forget that this is not legal advice, it's knowledge sharing. It's very important to have in mind. We have our business lawyer here to explain everything we need to know, and we're happy that you're here with us. Today, we're going to talk about something sexy as carried interest. The word you hear about all the time, but what is it exactly, and how does it work, and why does it exist? Kat is here, our business lawyer, to explain everything to us. Let's start with the juicy details.
The juicy. Well, it is. It's the carry. It's the get rich.
We love that.
Venture capital has partners, managers, the fund managers, the ones that starts the fund, that manages the capital, makes the investment decisions, and that once the fund is profitable, if it is profitable, gets a return of that profit. So they have LPs, investors, and we have the GP. And we use the example, Stellar Fund number 3, which you, Ida, had founded. So you're part of the Stellar Fund Management. Fund number 1, Fund number 2, and now Fund number 3.
Yeah.
So you will be entitled to carried interest on this fund if it goes well. So if I, as an LP, an investor, get my return of capital and preferred return, then you will be entitled to 20% of all proceeds from that fund. And now we're talking money.
We're talking money now.
Yeah. And if you heard about the 220, it will be 2% in management fee, which will be yearly. So in our example, we had a fund which had committed capital of 500. So already the management fee of 2% of 500, that's 10 million yearly for salaries, deal costs, offices, anything. That's quite okay.
Yeah.
So you will already have a good salary baseline. And of course, if you're a new challenger fund, you might not even charge a management fee. It can be higher. It can taper off, so it's bigger in the first years and lower the last years because you don't have the same costs. Because typically, the manager will have the investment costs, the due diligence when you invest in the startup. But when the startup makes an IPO or other exits, the costs will be on the startup, not directly on you as a VC. So it can vary, but the 2 and 20 model is good to have heard because that's the typical. And now we're talking about the carry, the 20%. And in the last episode, we showed the waterfall with 4 steps, where step number 4 was full carry mode. Number 1, return of capital. Number 2, preferred and the hurdle rate, 8% to the LPs. Number 3, the catch-up, so we make sure that you do get that 20% of all of the proceeds on top of the committed capital. And then we have the full carry, 20%, step number 4. So in that example, we ended up with 200 million in carried interest.
Which is a lot.
Yeah. So now we're going to show how that typically is divided. And before we give you those insights, we're going to mention that the big kind of discussion or the sensitivity around carried will be tax.
Oh.
Should it be taxed as income on top of your salary or as capital gains? And that's a huge difference. So pretty much all jurisdictions, this is a push and pull. And with the US, you might have heard of the carry loophole. But just mentioning it. Now let's go back to the 200 million that you have gotten in carry. So in order to know what does that mean, what happens with that, we will need to look at the VC, the management structure. So let's say that you, Ida, you are the face of Stellar Funds.
Yes.
You're the star, you're the core founder. And then you have 2 other senior partners on the fund, because typically the fund has partners. And then you just brought on 2 junior partners as well. So the senior partners are Becca and Alex. And the junior partners are Kat and Anders. And then you also have a deal team of 5, C-level and deal team. So they also have an entitlement to some of the carry. Typically, you will take the right to carry and divide it into units that you will apply already when you decide this, when you do not know the carry full out typically. So you're entitled, you have 10 units in the Stellar Fund that you will portion out to everybody who's entitled to carry at all. So you're the super senior partner, so you're entitled to 3 units. And then we had Becca and Alex as senior partners. They're entitled to 2 units each. And then we have the junior partners who are Kat and Anders. They have a right to 1 unit each. And then the deal team and the C-level, they have a right to 1 unit in total, split amongst themselves. That means that we had 10 units in total. So if you have 3 units and we have a result of 200, we take 200 million, divide it into 10 to know what each unit represents. So 200 divided into 10 is?
20.
And you have 3 units. So then we take 20 times 3, and that is?
60.
Which means that you get the nimble sum of 60 million US dollars in carry.
I accept that.
That is why everybody wants in on VC.
Yeah.
And you carry less of a risk than a startup, because the startup only has 1 chance. You have all of the startups that the VC invest in as your chance. You have risk diversification compared. So you get 60 million from 1 fund. And remember, this is fund number 3. You fundraise ongoingly. That's why carried interest is so sexy.
Yeah.
And then we had Becky and Alex. They had 2 units each. So then we take 2 times 20. So they get
40 each.
40 million each. Also okay.
Yeah.
And then Kat and Anders had 1 unit each. So 1 times 20 is?
20 million.
As a junior partner, I will be very happy to get 20 million in carried interest, right? And then we had the deal team. There were 5 splitting 1 unit of 20. So then we take 20 divided by 5 and we get?
2.
4.
4.
You're mesmerized by all the millions.
My 60 million.
Yeah, you stop there.
2 is nothing for me.
So they each get 4 million in carry. And then, again, this was just one of the funds. It's an ever-spinning wheel. And of course, if the fund does not reach full carry mode, if you do not make a profit, you get 0. So you need to perform. It's not for the faint-hearted. You need to really perform. If you do not perform, you might not even get to fundraise for a new fund, because all the LPs will say, well, thank you. I hardly got my monies back. I might as well put them in a mutual fund or in the stock market. But this is the core of how carry works. That's why it's so disproportionate for you as the GP to get 20% of that capital that somebody else put in the fund. So it's good to be a VC partner.
Yeah, it is. And this is very good information for those who want to work in venture capital, which I believe many wants to do.
I wouldn't mind.
I wouldn't mind too. Thank you so much.
Thank you.
And this episode is sponsored by LA Fitness. This is really good knowledge that we're sharing here, and keep yourself educated. I mean, we used to say keep educating yourself.
It is key.
It is key. And how do you do that? Well, you like, subscribe, and share to our channel, and also drop comments. If there's anything you need to know, want to know, have questions about, don't hesitate. I mean, we're here for you.
No, absolutely. If anything's unclear or you want to deep dive, we really do want to share this knowledge at 0 cost, because business law can be so exclusive, it can be so excluding, and we do not want that. That's why we're doing this.
Yes, and also if you have experiences, please share them, because I believe many people want to read about them.
Yeah.
Thank you. That's all for today on our Venture Capital Masterclass. Until next time, hej då!